Hello, haven't seen all of you for a long time. I think we have overall enjoyed our Thursday evening night classes, with the exception that while we are doing the practices, I guess. So like I said in the announcement, due to coronavirus, I decided to drop the second part of partnership accounting. They were supposed to be the more difficult part of partnership accounting, I guess. And like I said, they are not of urgent need for students to study anyway. And I think we tried hard enough to study the first part of partnership accounting. So I will drop that, and then we're gonna study partnership accounting. Why we still stick with that? First reason, although, you know, in terms of economic scale, ratio-wise, of course, the biggest employers in the market are private companies. I mean, the biggest companies, most of the companies are private, publicly traded companies. However, if we consider employment, the number of employers, the biggest in our economy is they are private companies. And most private companies are one way or the other organized as what we call partnership companies. And so I think it is when we are into the job market, no matter to start a job or switch a job, it is always important to tell, because it's always possible that one of your potential employers are partnership companies. And I think it's essential that we tell them that we know something about partnership accounting. On top of that, this partnership accounting, overall, it is easy. Most of the partnership accounting are not significantly different from the corporate accounting we have been learning. On top of that, because we indeed have, I'll put it this, some differences. So I'm going to explain where the accounting treatments, about the differences, where the differences in accounting treatments come from, why we expect such differences, and how in accounting generalization perspective do we capture those differences. So I think it's just meaningful class. You guys know what I think about accounting already. Like I said, accounting is about it's a very, very practical subject. It's not difficult, it's tedious. However, if we really, every time when we learn something we call new, if we really try hard enough to understand, to rationalize, to justify, there shouldn't be anything really difficult about accounting for us. And if we build our understanding step by step like that, essentially we're going to be super awesome. And we're going to be one of the, just going to be like people say about accounting, right? The more experience you have, the more valuable you are. I talked about this multiple times in our classes. The more experience, we are not referring to the years, right? It's not like, hey, 1 year later I'm becoming more experienced. Experience, we are referring to how much you have learned, what is the improvements in your ability. So that's something we have to talk about. And I'm doing this downstairs because my wife, she's taking upstairs workroom, and my kids are playing. Fortunately, they're nice kids. They're playing by themselves. But inevitably, they're still kids. So you will hear noises from them. So please don't mind. We are trying our best to cope with this situation, right? So if you think about a partnership accounting, what's the difference? Or let me ask, if you want to start a business, how would you do it? We heard about a lot of different forms, right? For example, sometimes you can see companies, there's a fix, that's the thing. After the company name, it says INC. INC means incorporate. So it's a corporation, it's not a partnership. And sometimes we see LLC, limited liability companies. Limited liability companies are a little bit more complicated. It can be a small business using a limited liability company form, or it can be a regular corporate using the limited liability company form. And sometimes we do see, for example, like LLP, limited liability partnership. And the limited liability partnership is different from the traditional liability, from the traditional or more common partnership we talk about. So what's partnership again? So when people start, like us, if we want to start a business, if we have an idea of what might be bringing us money, hopefully a lot of money with a lot of certainty, and then we want to start a business, right? So for you to start a business, you know, most of us, if not all, don't have $1 billion trust funds behind us. So we gotta start small, right? So you're gonna start small. You want to do a business. You don't want IRS to be after you. So you want to think about, okay, let me start a business. And if you have a CPA, and they would tell you that, hey, for you, I think limited liability company, but it's actually a partnership. Limited liability form partnerships. The key word of this partnership is most suitable for your business. Why? There are a few reasons, right? So you don't have, first, it's a small company. It's small, and you have the idea, you start it. You might be lucky to have your friends, your family member, your relatives to do it with you. Although, keep in mind, 99% of the time, it is a really bad business a bad idea to start your business with either your friend or your family. Of course, if you want to make what used to be your best friend your enemy, and if you want to kick your relatives away as far as possible, then it might be a good idea to do business together with them. But otherwise, it's a bad idea, okay? So if you want to do it, you find people to invest with you, right? And probably you won't be able to find a lot, right? You find a 2, you have a 3, you find more. And you know, for you, when you're small, it's never a good idea to have too many partners as well. If you want to start your business, for example, like a grocery store, a salon, I don't know, sneaker shop, a cell phone gaming company, how many people would you think about? Maybe 5, maybe 6. I think that's maximum, right? And also because you just started a business, not only your business module is going to be relatively simple, but also that you're going to start small, so there's not too much money coming in. So CPA told you, first, you don't have too many partners, you don't have too many shareholders, right? So it's easy because the accounting for partnership as private companies is much easier than for big corporates as well. Then, because your business might started being small, and for you, that's your only income, and they're not really a lot. So majority of the profit, if you make any, would be you would have to use them to support your family, to support yourself as well. So under this scenario, a partnership business is good as well. Why? Because when we say partnership, they have a quality called a flow through. What is flowing through? Profit from business is flowing through. Flowing through what? Flowing through the business. To where? To individuals. This means when it's running as a partnership, when a business, the money the business makes is actually going to be attributed on personal, right? On the personal, like personal income tax. So when it's taxed, the profit you made, the money you made from your business is going to be taxed at individual level. This is better compared to corporate. Why? Because for corporates, they have corporate tax. So when corporate make money, they pay first time corporate tax, right? So after corporate tax is paid, that's a profit for the company. So what can companies do with them? And we learned from our intermediate already, companies can decide either to keep the money, retain the money within the company for reinvestments, that's one. And a second, to give to the shareholders as dividend. But not many people realize when shareholders receive dividend, they're going to be taxed another time at the rate of capital gain rates. This is called a double taxation, which means if this company is registered as corporate, so when shareholders, when capital contributors receive their dividend, they are being taxed twice already. While if you run a partnership, you're only going to be taxed once at the individual rates. So a corporate form of business might be beneficial for you when the company becomes really big, when the company has a lot of investors become really big. In that case, because most corporation tax rate is much lower than individual level. So, and you don't need so much money, and you need to retain money in the business to make business bigger. So in that sense, choosing corporate form of business might be much better. But at least when you're starting, while your business is not there yet, partnership form of business is much more straightforward, right? So that being said, okay, so what can, let's think, how can partnership be different from the normal corporate we talk about? We have been learning from individual accounting, from the first half of our advanced accounting, and from intermediate accounting, not individual accounting, okay? So how is different? I mean, if we think about the financial statements, in specific balance sheet and income statement, how would it be different? Think about it. What is balance sheet for? We thought a balance sheet is to record at a certain point of time the asset and liability composition of the company, right? Situation of the company. So what does that mean? It means that on the left-hand side, we're supposed to see what resources the company had and in what forms and the company had, right, at that point of time. So we have current assets, cash, AR, inventory, some stuff like that. And we have long-term assets like PPE, like intangibles, like other stuff. So would you expect it to be different for partnership? Probably not. So for assets, we don't expect differences, right? And on the right-hand side, the top of the right-hand side of the balance sheet, it tells you at that moment of time, at that point of time, how much and to whom this company owe money to. Oh, coughing is a particularly annoying thing in these days, right? I don't want to cough, but holding it is not healthy as well. So if you think about it, right? For corporate, for partnership, if they need to borrow money from outsider, they still do it. So sometimes they borrow money for short term, so it's current liability. So like for example, like they purchase from their supplier, they pay 3 months later, it's going to be AP, right? If they borrow money from a bank for 6 months, it's going to be short term liability. If they borrow money from SBA or whatever lenders for long term, it's going to be long term debt. So technically speaking, there's no difference between corporates and partnerships as well regarding liability. And then we come to talk about equity, right? For equity, I don't think, let's think about it. What are corporates like? Corporates, so far we learned we have common stock. And what is common stock? Common stock, we said, is the value of a common stock as a face value of common stock, each share multiplied with shares outstanding. Why that? If we think about it, what are corporates are we thinking? We have Microsoft, we have Google, we have Amazon, we have Dell, and those companies are called publicly traded companies, and they have millions and maybe tens of millions shareholders or shares available, and everybody able to pay the money can buy them from the stock market, and anybody need the money and with the shares on hand can sell those for money, right? So we knew that already. So how does that matter to us, right? With so many potential shareholders out there and with shares exchanging hands, meaning that some shareholders retire, some shareholders walk in, new shareholders walk into the game all the time, it's important for companies whose shares are publicly traded, circulate, to keep track of their shareholders. Right? So we do not expect corporate equity to reflect that. However, and those shareholders of those big companies, they are so far away from the company. I mean, you might be in Africa and you can still buy shares in US market, become a partner shareholder of the US company, but it doesn't mean that you can necessarily come here all the time. So they are inevitably far away from operation. So for those people to need to look at the company, they need the financial statement to understand what is going on for the company to decide whether I should buy more shares, sell more shares, or hold on to it. So what do, right? They rely on, we knew that already, they rely on financial statements, and they don't just take the word of the CEOs, whoever announced a financial statement, because they might be lying, so they need to audit the financial statements. right? And audited financial statements have assets, liabilities, and they care about the equity part because particularly it captures how much nets for shareholders. And what do we look for? For them, they need to know how many shares are outstanding, what's the value of them. So we have common stock, right? And they also need to think about, hey, on top of that, right? While people issue stock, they issue stock at higher than par value, face value. So if we think about it, if you want to know historically in a nutshell, how many shares has been issued, and averagely on the average basis, how much they have been issued at compared to the face value, we can look at additional common stock, right? And then if you are interested in a business, for them, the business has to be there for 10 years, and this year you're considering being part of the shareholders. So I think, of course, you want to know, for example, hey, since the business has been created, how much money this company has made, right? Because if you look at a company, for example, both companies have, let's say, 1 million equity, right? Company number 1 million is purely common stock, nothing else. Company number 2, for example, 100,000 common stock, 900,000 retained earnings. Which one would you be more interesting? If I were you, I would be more interested in the second, because they told us, hey, common stock original contribution is 100,000. However, the company has been doing well, and from the day they were created, they started operations, they have created and retained the company at least 900. The retaining the company $900,000. Compared to case number 1, the company originally started with 1 million, and they haven't made a dime more, still 1 million, retained 1 dime more, right? Not made, retained, because they may have been given all their money as cash dividend already. So at least this tells us something. So as a shareholder who's far away from the operation of a public company, right? You need to know all this information, and we look at a corporate's balance sheets, and we see these in the equity parts. We see common stock, we see additional paid-in capital, and we see retained earnings for basic accounts, and they exist there for a reason. However, for partnership, so let me ask, right? Let's say you have a relative. I have which country? Let's say you have a relative far away in France. Okay, don't like coming to US because it's so boring and don't speak English, right? May speak a little bit English, right? So you are starting a business. So let me ask, did I say relative? That's your cousin, okay? So let me ask, of the potential candidates for the partners for your partnership, would you think about your cousin in France? Probably not. Why? Because first, he's so far away, right? He's so far away, and second, he's so far away. Third, he's so far away. Because why? That's not good reason. Because he's so far away, he cannot be in management, and he's so far away, he might be concerned that he won't be able to manage as well, and he might be concerned you'll be lying to him, and he wouldn't know, and you will be concerned as he's so far away, and he cannot do anything for the partnership, and you'll be doing it all, and he won't be able to understand what's happening to the business. Now, why I bring this? Because if you want to start your business, it's most likely, it's not required, but it's most likely is that you're going to start someone who cares about your business and who wants to be, has the ability to be part of it, or at least who will keep being posted by you, and who has interest to be posted, to be updated by you, right? That's what I'm talking about. So for partnerships and how many partners you can get, right? You want to get 100? With 100 people, you would get nothing done, right? If you want to have a meeting, if you want to get something done, the lesson we learned is have as few people as possible. Okay, so 100 people, you have a meeting, you will get nothing done, right? So maybe most people would control it under 5. Some people might think, okay, I don't even want to. Some people might control on 10, and some people might tell me, I don't even want a 10, maybe 5, maybe 2, or maybe just me if I have the money, right? So fewer the possible. So probably you want to have more than 5. So the good thing is all of you will keep track of the business, right? Meaning that all of you will, and if you keep track of business that you are so close to, what do you care about? How much we made every day, every month, every week, and how much we spend on this, on that, and and what's the net profit of it, what's the maintenance cost, what's the storage, what's the inventory level. You care about everything. So those people know business already, and they know how much money they have been making, they know how much their shares worth, and of course, because it's a small company, their shares is not publicly being offered, purchased, or available on the market, on the stock market. So there's no point talking about common stock, additional paid capital. And on top of that, because everybody is so close to the operation, there's no point talking about retained earnings because everybody knows. However, because there are so few small number of partners over there, and everybody cares about it. With the business going on today at this moment of time, how much is my share worth? I paid $50,000 to be in, and if my share is worth $70,000 after a year, probably I'm much better off and happy. I care about that. It's the most straightforward way to provide them with a view of whether their shares has been doing well or not, whether their business has been doing well or not, right? So if we think about it rationally, the biggest difference in terms of accounting treatments between corporate accounting we have been learning and the partnership accounting we will be learning is going to be lying in the equity parts. And how different would it be? In what way would it be different? For corporate accounting, we don't distinguish, we cannot distinguish different shareholders with that for a few reasons, right? First, so many shareholders and the shares exchange hands all the time, right? And for the very similar reasons, so which why in corporate accounting, when we talk about equity, we see common stock, we see additional paid capital, we see retained earnings, okay? Because people need those information. And sometimes the company can provide it by shareholder information. However, for partnership, because there are so few partners, because everybody is closer to operation, right? Because everybody cares about their own share. So for partnership accounting, we do that something different. We don't distinguish between common stock, additional paid capital, or retained earnings anymore. However, we just care about the total amounts, and we care about the total amount under every partner's name. So for partnership accounting, when you talk about equity, you will see that capital, for example, under Adam, capital under Betsy, or capital balance of Betsy, capital balance of Casey, capital balance of Doc, and there's respective balances. And they will add up, of course, equals to the difference between total assets and total liability. So they will be the equity as well, right? And every transaction, when it generates profits, the profits will allocate under every shareholder's name. So everybody's capital balance will be higher. When it generates loss or when the expense happen, those will be allocated, reducing total equity, and will be allocated under everybody's name as well, okay? So today we start soft. It's just some general information about the partnership accounting, and we know that it's going to be, the difference is going to be lying in the equity account. So that's what we're going to be working on. So from next class, which I'm going to make a video when it's a little bit quieter, I'm going to share you with my screen, give you a few practices, share you with my screen, and we're going to do some work together. And what I'm thinking is after 2 videos, probably 2-3 videos, 2 most likely, every video will last about 30, hopefully no more than 1 hour, okay? So we're gonna be able to finish this partnership accounting, and we will host a real-time Zoom meeting, pick a weekend, and we can do some Q&A, and we'll be ready for our next event, all right? So see you next time.